Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Edge Group. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
Another item that interests me, Dan, is the current exchange rate. I know recently I've heard some economists talking the Australian dollar down based off of trade with China potentially being curtailed a bit with different geopolitical issues. But what's actually happened is that wheat, oil, gas, iron ore, all those things have gone up, and which has driven demand for the Australian currency. So I'm just curious about your perspective on, how the Australian currency might affect earnings that are being repatriated back from say the US, in the likes of companies like Amcor, who do a lot of their trade over there.
Yeah, look, currency is always an issue. Look, as you guys know, the Aussie currency is interest rates and commodities are the key drivers of the Aussie, and obviously what happens with interest rate differentials between our market and the US market. And obviously the outlook in an inflationary environment, the outlook for commodities is strong, and the RBA is going to be raising rates pretty quickly soon. So that should be positive tailwinds from a currency perspective. But I guess from a portfolio perspective, look, currency remains a very difficult area to predict. And in the short term, the movements are close to random. And so taking a long-term view is very important in this regard. From a portfolio perspective, we have a strategy called the strategic hedge ratio that we monitor across our portfolios, and also that sets out the optimal long-term FX exposure in our portfolios from an asset class perspective. Now, look, it's important to note that from a currency perspective, hedging has historically had a limited impact on portfolio returns. If we look back historically, the long-term returns for a hedge portfolio and an unhedged portfolio have been very similar on a longer-term time frame. But what it has an important impact on the volatility, short-term volatility of the portfolio because of those currency movements. So to manage this across as a portfolio level, we sort of implement the hedge ratio on an asset class level. So our Aussie and global equities, we tend to have them as unhedged. And from a asset class perspective, the lower volatility asset classes are more, they need more hedging. So your global property, infrastructure, and global fixed interests, we tend to have them as hedged exposures, and the rest is unhedged. From a direct equities perspective, we do have a combination of businesses that earn a lot of the earnings from foreign sources. You got your CSL, some of the healthcare businesses, ResMed, which is a US-based business, and Amcor, which is businesses all across the globe. So, and it's not just one currency that impacts this. So it's the euro that impacts the Amcor, for example, US dollar that impacts CSL and ResMed, and it depends on where they get their earnings. So net, I think it's more about, once again, not having all the portfolio exposed to one factor, in terms of just being aware of where our currency exposures are. We tend not to have a huge call on currency in terms of the Aussie going up and Aussie going down. And the earnings tend to look after themselves. We're more focusing on the ability of the company to grow its earnings, and the currency becomes secondary unless we're at extremes like the dollars at 50 cents or as dollars over parity. And this is historical extremes that we can make a more educated estimate in terms of where the upside risk and downside risk are.